What's up everyone? Welcome to the birthday edition of our community investing, brought to you by PerFinEx, the #1 English-speaking and independent financial planner in Germany. Exactly 1 year ago, we started our community investing. So time for me to thank each and every one of you that trusted us with your hard-earned money. And since I had birthday a couple of days as well, I'm not 1 year old, but whatever, I can wish for something as well. Right? For my birthday, I wish me a market crash. Yes, I'm being absolutely serious here. I wish for a crash, and so should you. So let me explain to you why the last months have been absolutely perfect in this episode of our community investing. Meet William Bernstein, an American financial theorist and neurologist that published many really good books about investing and portfolio theory. He says, if you are a 20-something just beginning to save, then get down on your knees and pray for a market crash. What does he mean by that? There is a fundamental difference between the average market return, saying, for example, that the S&P 500 has an average return since its inception in the 50s to now of around 10.5%. That is the average market return that you would have gotten only under one single condition. If you would have invested money into the S&P 500 at inception date in the 50s and never did anything afterwards, neither taking money out nor investing more. Who did this? Probably nobody. At least nobody of you guys from the community. Most of you guys have monthly savings plans in order to profit from the cost average effect. If you invest on a regular basis, you couldn't care less about the average market return. What you care about is your internal rate of return. Because when the market is down any given month, you buy a lot of shares here, and when the market is up, you buy very little shares here. And when you actually do the calculations, I don't want to bore you with a lot of numbers, just believe William Bernstein and myself here, it is highly beneficial if the market crash comes at the beginning of your investing journey rather than at the end. I mean, think about it. You invest 100 euros a month and after 1 year of investing, the market drops 50%. That is 600 euro gone from your 1,200 euro investment, whatever, right? And also, while the market is going down, you continually buy cheaper and cheaper. The market has just to recover eventually. If you invest your 100 euros a month for 40 years with a 10.5% average S&P 500 return, you have over 640,000 euros. But Axel, how did you calculate that? I used the savings plan calculator on our website perfinex.de. If the market crashes now by 50% right before you want to retire and 320,000 euros out of your 640,000 are gone, you might be in trouble, my friend. An early crash is really good for your investment performance if you behave the right way. And that's the challenge here, because a portfolio that keeps going down and down is tough to handle. When you just see your hard-earned money become less and less every day. Even for me. By the way, thank you all for the nice messages you guys sent us that realized it is tough for me to do these videos while everything's red. Thank you really from the bottom of my heart. You have no idea how helpful that is to read your messages. If you are wondering what the right investing way during a market crash is, you can check out episode 10 of our community investing, in which we discuss the 3 investing rules from arguably the most successful investor of all time, Peter Lynch. So especially when comparing our community investing return with the 1-year return of the S&P 500 or the German DAX, we know that the changes we've done to all 3 portfolios in the last episode have been correct. We're not nearly as much down as the major indices. Let's talk about the returns of the last month. High safety investing strategy that was changed the most with the last rebalancing is up last month. Finally, some green charts again. I think this is actually the first green chart in the last 3 months. Feels so good. In fact, all 3 investing strategies are up over the last months. So 3 out of 6 charts are green in this episode, 3 more to go, and I'm happy. In July, the high safety investing strategy is up by more than 5%, so a 10,000 euro investment 1 year ago would be 10,000 euro and 145 today, which is absolutely insane that we have a positive return in this market environment. Portfolio value stands at 9,750 euro, up from 9,160 euro last month. Check out the last episode if you don't believe me. So almost 600 euro portfolio increase. On top of that come the 395 euro dividends you would have gotten with a little 5 euro dividend last month. High safety is the only investing strategy with a positive return over our first year. The most prominent portfolio, passive income, stands at about 9,700 euro portfolio value, up by about 460 euros from 9,240 euro last month. Again, everything documented in the last episode for you to check out in case you have any doubts about the numbers that I'm presenting here. With the 246 euros in dividends that would have been paid out over the last year, with a big one right around the corner coming August 16th, the total portfolio value stands at 9,940 euros, so minus 0.6% over the first year. Considering the worldwide indices are down by about double digits, we can be content with that result. Not happy, but content. The only investing strategy that is down quite significantly is high return with exactly 9,000 euros portfolio value, so up by about 500 euros from last month. Almost 600 euro portfolio increase in high safety, 450 euro in passive income, and 500 euro here leaves us with over 1,500 euro portfolio increase in all three investing strategies combined. That is really good. I would love it for all of us involved if that trend continues and the current bear market is over, but nobody knows. Please don't get greedy now, thinking that it's all over. Minus 10% in portfolio value plus 170 euro in dividends leaves us with minus 8.3% over our first investing year with the high return investing strategy. That's not high return at all. That's high. Let's see what happens. Once the market picks up again, this investing strategy should profit the most. If you would like to join our community investing, because maybe now is a really good time if you think about Bernstein, you can open your personal investing account with Fidelity completely online with a link in the description. Takes just a couple of minutes. It's completely free if you choose the regular account. You don't need the plus account. After you completed your registration completely online, you will get sent a link from Fidelity where you can identify yourself either with video ident from home with your smartphone or offline with post-ident. That's a very important step because if you don't identify yourself, Fidelity will not open your personal investment account. After you finish your registration and your identification, it usually takes Fidelity a day or two to open your investment account. We will see it before you do because we can see it electronically before you get your login details by post. In that time, we will reach out to you so we can set up a meeting and discuss the right investing strategy for your personal financial situation. I wish all of us that the returns of the last month continue over the next few months, but we'll see what happens. See you next month, investors.